for the time being, let's welcome our first management on the show, Brigade Hotel Ventures. That's the first management on the show. They reported a softer set of numbers in the second quarter, but the debt repayment has boosted the profitability. To discuss this and more, and what's to be ahead, we are joined by Nirupa Shankar, the Managing Director at Brigade Hotel Ventures. Hi, good morning, and good to see you in, as always, Nirupa. Well, the last quarter was a little bit softish, Nirupa. But tell us, what kind of numbers should we look at, in the second half of the year? Whether it's with regard to the RevPAR, whether it's with regard to the occupancy, how do you see things shaping up, and what are the targets on that front? Nirupa, go ahead.
Yeah, good morning, everybody. Thank you for having me, Nigel. Our quarter two has actually been pretty good. Quarter two, as you know, in the hospitality sector is one of the softer quarters, but we have managed to show a 20% increase in revenue. We've managed to show a 13% increase in RevPAR, and we've also managed to show a 58% improvement in profitability. So according to us, the quarter went pretty well, and we're pretty happy with it. Obviously, the only thing is with the EBITDA margins, I would say we had a one-time additional expense. So that reduced the EBITDA margins slightly. But if that was not the case, our EBITDA margins were also on track. Same store EBITDA margins, we would have shown about 36% of EBITDA margins. So overall, the quarter went pretty well. Coming up, I think, as you already know, the second half of the year for the hospitality industry is generally the stronger year, with the wedding season kicking in, a lot of MICE and conferences taking place in the second half of the year. So we believe that especially the coming 2 quarters will be extremely strong, especially with months of November, December also looking very strong in the coming quarter.
All right. What is the target ARR, though? You have that 5-star property that's going to be coming in on stream. So if you could help us out on that front, what should it look like? Directionally, where does it head to?
Typically, the ARRs that we conservatively take is around 10%. I mean, you want to take either high single digits or low double digits for an ARR growth as a conservative approach. But overall, if you look at the top line that we typically aim for with the same store hotels, if we just do a like-to-like, then we are looking at least mid-teens to high teens kind of a growth rate. And I think that's a very sustainable growth rate. Of course, some quarters you might do better, some quarters you might do worse. But overall, for the year, I think something in the range of mid-teens to high teens is a very acceptable and a sustainable growth projection.
So, Nirupa, hi, morning.
Hi.
So, just to talk about this going forward, when you say second half is going to be stronger, I mean, can you quantify that? Let's also talk about how many more rooms you'll be adding, or how many more keys you'll be adding this year. What the rollout is for the next year plans, and then therefore that gets us to the question of investments and debt as well. So what are you working with in terms of debt levels this year and then rolling over into next year?
So, our current debt is extremely healthy. We just completed our IPO process, so we were able to reduce our debt level significantly. Our cost of borrowing also came down from about 8.6 to 8.2%, which is again one of the healthiest in the industry. Current debt levels are not very high. It's only about 200 odd crores, of which about 160 crores is to the parent and another 40 odd crores is an overdraft facility. In terms of debt to EBITDA, I would say the ratio is 1:1, but debt is to equity is currently 0.22. So and this is gross debt. If you look at net debt, it's actually negative. We have more cash and cash equivalents on the book. So our net debt is actually negative, but the gross debt is around 200 crores, as I mentioned. So it's in very healthy percentages. Going forward this year, as you know, we're a development company. Hotels do take their time to develop, but we have a huge number of hotels in the pipeline. Currently, we have 9 operating hotels, and we are in the process of building out 9 more. Most of these hotels will come out after the year FY 28, 29, and 30. So they're under various stages of design, development, and construction as we speak. So we are building out, like I said, we're doubling up our portfolio. Today we have 9 hotels and 1,600 odd keys. The portfolio will double up in the years to come to 18 hotels and 1,700 keys. And these are hotels where we've already signed up the brand. The kind of investment we're looking at, a lot of our portfolio will undergo a bit of a change because we are moving into more of a five-star luxury deluxe category. So the average cost per key investment that we're looking to put in, if you look at the construction cost, land, internal accruals, debt, all the pre-opening expenses, etc., it should be about two crores a key, which amounts to about 3,400 to 3,600 crores overall that we would look to put into this company as in terms of investment.
And that's going up to FY28, right? This is investment.
Over the next 4 to 5 years, I would say. Some hotels will start coming into the portfolio in FY28, but the hotels will, like I said, the 9 hotels will start coming in 28, 29, 30. So I would say this investment, you can say, is going to come in over the next 5 years. I would put it that way.
Nirupa, hi, this is Rima here. I remember our last conversation around the time of the IPO, and you said that we're planning to do in the next 5 years what we did in the last 16 years. And, you know, you're on track in terms of doubling of keys. From 1,600, you're planning to add another 1,700 keys by, you know, in the next 4 to 5 years. Just, you know, talking about the near term right now, can you give us an indication of the kind of advance booking you have for the October, November, December quarter, or even for Q4 FY26? What could the potential occupancies look like, considering it's a strong quarter for you?
Currently, the occupancies our portfolio is trending around 75%. It's the way hospitality is. The advanced bookings are not a good reflection because the time to book is actually reducing. You know, so you get a more accurate picture maybe 2 weeks in advance rather than a few months in advance. But like I said, our portfolio is trending at around 75-76%. I expect this to continue to trend in a similar way or go up by 2-3 percentage points, which is what we have sort of stated, where we are seeing the major growth coming from the ARR. In fact, our ARR growth has been about 14 to 15% for the entire portfolio. But if I just look at the Bangalore hotels, where most of our hotels are currently based, at least 40 to 50% of our hotels are based here, it's almost 20%. So the ARR, there's been a push for ARR drive. Occupancy, like I said, our hotels are 75 to 76% is a pretty healthy occupancy rate for the entire portfolio. So while it may go up by a few percentage points, but our focus is on actually on the ARR, which is where we're seeing more of the growth.
Okay, we'll leave the conversation here. Nirupa, thank you very much for joining in. So the key metric to track for Brigade Hotel Ventures will be the ARR growth, the average room rent. In Q2, 14%, but in some of the key properties in Bangalore, it's at 20%. And as the company moves towards a more premium offering in terms of hotels which are in the pipeline also, the company expects the ARR to remain very strong.